I want to thank Phil for and his team, and Becky and his whole team at the American FinTech Council for organizing this panel. I'm delighted to be here, and delighted that the council is focusing on this issue. Why are we here, and why am I delighted? I'm delighted because this, as Phil suggested, this product or set of products, EWA, Earned Wage Access, is really a tremendous product for consumers, and we're really at a crossroads where it's really finding its momentum and finding its way to consumers across the country, and also finding its fit within the regulatory landscape, how best to regulate it. And states and the federal government are looking at that. So we're going to be talking about that. So it's really a critical moment in the history of this product. And we have here on this panel a few of the people who know most about the product and who are in the front lines really fighting to make sure that consumers get access to it in all its different forms. So let me take a moment to introduce our panel, and then we'll dive right in. So first, we have from CLEO, Rajat Agarwal, who is the Chief Credit Officer at CLEO. Welcome, Rajat. Second, we have from DailyPay, Claudia Flores, who's the Public Policy Manager at DailyPay. Third, we have from PayActiv, Molly Jones, who's the Head of Public Policy. Welcome, Molly. And last but not least, from EarnIN, we have Ben Larocco, the Senior Director of Government Relations. Welcome, Ben. So I'm delighted to be here with you all today. And I'm going to begin our discussion with you, Molly, and ask you, if you could, to really provide the viewers and listeners with kind of an overview of what Earned Wage Access is. What does it mean when we talk about Earned Wage Access?
Great. Yeah, happy to. And thank you, everyone, for being here. I unfortunately can't see you, so I'm just going to have to assume you're laughing at all of my jokes. But yeah, thanks for being here. At a high level, Earned Wage Access was invented about 10 years ago. So it's a relatively new technology. And it's a payroll innovation that allows workers to access their wages as they earn it without having to wait for payday. And it's really designed as an alternative to other high-cost predatory products like payday loans, overdraft fees, credit card debt. And it has several really important features that make it different than those lending products. There's no recourse ever. There's no late fees, no interest or other penalties, no costs of those kind to the user. There's no credit impact. So there's no impact on your credit score for using Earned Wage Access, and no credit worthiness check to participate. And there's no underwriting, and there's no debt created. So it's really designed as an alternative to those lending products.
Great. And how is it how is it paid for? In other words, how do the employees do they pay a fee for the service? How is that usually done?
Yeah, so each provider has a slightly different pricing structure, but generally every provider offers at least one free option per the legislation that was passed in Nevada. PayActiv has 5 free options for users. There's a $2.99 flat fee, no interest, late fees, or penalties there to transfer your wages to any bank account. You can do instant transfer to our debit card for free. You can also load to your Amazon account, your Uber, or do an ACH bank transfer for free.
And that free option is a key part of the legislation in a number of some of the states that have actually addressed this specifically with legislation. So Ben, I want to turn to you for a moment. So are there specific industries or types of workers that tend to benefit the most from Earned Wage Access at this point, or that you're seeing out there?
Sure, Jeremy, thanks for that question. I think one thing that, as I've dug into our data a bit, is that the Earned Wage Access customers really reflect the American workforce in general. It's not concentrated in cities, it's not concentrated in rural areas. It's anywhere where folks are working and living paycheck to paycheck, they use Earned Wage Access. So I've dived into EarnIN's customers a little bit, and essentially what you see is I think there's a couple fairly large buckets. Retail workers is probably the number one. You have they also they tend to be the largest employers. So you have large retailers. I think most of the companies on this call have a partnership with with large retailers and provide a service to their employees. Second is healthcare workers. Again, it's an industry that's very very human capital intense. So whenever I will look in a state at the employers of our employees, hospital systems are almost always in the top 10. And then the third one is like teachers and government workers. So you see a lot of teachers and just other government workers that are hourly workers. So we did a study a couple months ago and we found that 100 congressional staffers use EarnIN. And I've actually found 2 different state representatives, like sitting state representatives that use EarnIN as well. So it's really all walks of life. There's not any concentration across demographics or geographies, but it's really anywhere where folks are living paycheck to paycheck.
And have folks seen a sort of as it's grown in adoption, have folks seen sort of certain types of workers or certain sectors sort of the uptake in those areas growing more recently in particular, or has it been pretty steady across sectors?
So I'll take this one as well. I think, what the pandemic was a very big change for the industry. I know it was for EarnIN. Basically, in the beginning of the pandemic, when you saw the K-shaped recovery, the bottom part of that K was really the folks who are using EarnIN and using the customers or using the companies on this call. A lot of those folks lost their jobs. They're the ones that are going in person, that retail was closed. The part of the economy that was really sort of changed dramatically. And then for a while, those folks weren't working. They were, there was government support and those jobs weren't available. But then I think once that sort of ended and you saw costs really increase quite a bit, saw gas skyrocket, cost of housing increase, like as inflation went up, those folks that were working again, they had wages, but they saw their costs increase faster than wages. So I know, we saw a big dip in the recession, in the pandemic, but then a lot of growth, a lot of usage, a lot of demand from those workers since then.
I would also add too, it's become increasingly popular for folks who are competing with the gig economy or employers who are competing with the gig economy. If, I'm someone who has an unexpected bill come up and I'm an Uber driver, I can pick up an extra shift and I'll get paid later that day. That before earned wage access didn't exist in a lot of those more traditional hourly sectors. And now folks are able to pick up those shifts and earn that extra money in those traditional sectors.
Molly, you raise a really good point, which is, and I want to explore this a little bit, getting back to your points about sort of some of the benefits of EWA for employees. Can you guys, Molly or others, spin out a little bit more what it means for an employee to have this product? I mean, I think that I've seen some research even impacts on reducing turnover. The value of this flexibility. I think it's often lost how important it really is, especially for folks who aren't earning a ton of money, who don't have a cushion or as big a cushion as others, to have that flexibility and what it means in terms of avoiding other kinds of costs.
Happy to take that, Jeremy. And thanks everyone for joining us. My name is Claudia. Once again, I'm with DailyPay. We are one of the leading providers of on-demand pay. Molly and Ben have outlined, what the industries that are utilizing this product look like. And I'm happy to take what it looks like for not just for the users, but also the employers that we partner with. So DailyPay functions under the employer integrated model. We have partnerships with some of the largest employers from across the country. Employers are increasingly utilizing this financial wellness product because it has allowed them to recruit and retain their talented workforce. The reality is that, even, before the pandemic, Americans wanted to earn more money. They wanted more flexibility at pay. And we have seen that continued trend in the past, recent years. So the way we operate is we actually integrate with some of the largest payroll management systems. We have an integration, software model that works real time in attendance. We are able to see how much you're making. A user will have the app. DailyPay is something that you can only access if this is something that your employer offers. Because of some of the benefits to the employer, we are seeing more increasingly now a lot of employers allowing this product to be part of the broader package on financial wellness that they offer, some of the benefits that they offer to the employees. And because we're able to see in real time how much you're making, this also gives users the ability to see how much money they have earned so far, and that will factor in a decision whether they want to take an additional shift or whether they actually, if they have an unexpected expense. This gives them the flexibility to, take that money when they need it. This is money that they've already earned but hasn't been paid because of arbitrary, pay deadlines. And also, on the employer side, we are providing, preventing them from having the logistical nightmare or figuring out how to, provide a worker with the money that they've already worked for. So that is how our model has functioned. We have 1.4 million users across the country. EWA is definitely something that is impacting so many workers. And I think the more people learn about this innovative financial product, the more they realize that, this is a great product that everyone should have access to. And when you look at just the numbers as well, a majority of Americans don't have savings to actually deal with an unexpected expense, whether that is a health emergency, you have a flat tire, all of a sudden you have to change your tires, or you have a visit to a doctor and you have to wait until payday, right? That's just not how real life works. So, people have already, earned their money. So rather than waiting for this, payday, they can actually go on our app and take the money that they've already earned and be able to pay their bills on time, cover any fees that they may incur as a result of it. What this actually does for them is that it allows them to not fall into debt, right? Which that is unfortunately what we're seeing. This is an alternative to what would be a higher cost liquidity option, like payday loans, credit cards, borrowing from friends and family. So this has been a safer alternative for many workers. So we're very proud of our product. I know the folks on this call are also, have excellent products out there in the marketplace, and we're happy to tell you more about it.
So that's great. Thank you, Claudia. Let me turn to Rajat. And your CLEO has a slightly different model, that's not employer integrated. And can you tell us about that model and how that serves consumers in a slightly different way, but in important ways?
Yeah, absolutely. Thanks, Jeremy. I'm Rajat Agarwal, Chief Credit Officer at CLEO. We are, as Jeremy mentioned, direct-to-consumer EWA provider. And this market is very interesting to me now because EWA is accessible almost to everyone now, irrespective whether your employer offers it or not. If your employer offers it, you have solutions, right? Companies like DailyPay and PayActiv are offering it. But what if your employer does not offer it? What do you do? And then there are direct-to-consumer models where it's possible to use technology to connect to the payroll data as well as other bank transaction data to understand how many hours are people working every week, how much are they getting paid, and how much have they accrued. And based on that, you can calculate their on-demand earnings and give them access to that. So the biggest difference in my mind between employer integrated and direct-to-consumer models is essentially wage verification. The employer integrated models tap into the employer's payroll systems directly and have direct access to it. The direct-to-consumer models try to use other data sources to make the same determination. The most important bit to highlight is in terms of consumer benefits, they are pretty similar. So some of the benefits that Molly has previously highlighted, the consumer protection features such as non-recourse to the consumer, no debt collection, no reporting to the credit bureaus, no interest charges, ballooning the payment if users are not able to pay on time, no late fees, nothing of that sort. So in terms of consumer benefits, they are fairly similar products.
Molly and Ben, I don't know if you want to add anything on this this issue of the different models, or what. I know your companies have products in one model.
Yeah, I think I think one reason, so EarnIN has employer partners, but we also we're direct to consumer as well, so anybody can download the app and use it. I think one reason why the overall fees are low here is that there's a lot of competition in the industry. Even though it's a new product, there's a number of players involved. We'll talk about this in a little bit, but Missouri was the first state. It wasn't the first state to pass a bill, but it was the first state to get its licensing product request out there. 21 companies applied for a license in the state of Missouri. And so not only do you have competition between consumers or between companies, like, if your employer has an option, but you don't like that, you can use a direct to consumer company. I think because of the free option, that also provides a lot of competition within ourselves. So we have to ensure that anything we're charging for is a strong enough value proposition that it's something that the customer's willing to pay for. So because of those things, the different business models, creating competition and competition with ourselves, that makes the product robust and affordable and value driven for the consumer.
I imagine that also as employee expectations for this to be available increase across, space and time and numbers, it'll become almost a required, aspect of what employers offer. And that in turn produces more competition because there's more of a need for providers to provide this service. You can almost imagine a world in which no one will accept not getting paid, virtually instantly. Molly,
yeah, that's a really good point. Especially, I love Gen Z. If you look at Gen Z, their whole life is on demand. Anything they want, they can order it immediately. And we find that same expectation translates to their pay. Every survey we've done, Gen Z is really expects this on-demand pay, and they're sort of at the bleeding edge of, and it goes on up from there on other generational tracks. But
I'm glad to hear that someone loves Gen Z. I'm not sure. You may be the only one, but that's good. I'm interested sort of in people's views on sort of what kind of trends you're seeing in the adoption of EWA. We've talked about this a little bit. If folks have anything to add on that, either new sectors or just sort of the preferences or things you're seeing in your research. And Claudia, I think you had already spoken to this a little bit. If you have anything to add. If not, then we'll move on.
Yeah, I mean, I think the only point I'll make is that, we are seeing this across industries, right? This is not something that is necessarily unique to, I think folks think that the folks who are using EWA are typically just maybe folks that work in a specific industry sector, but we're seeing across the board. Ben has outlined that they have Hill staffers. I know working on Capitol Hill, you used to get paid once per month, right? There is no reason why in today's world of innovation where you can tap to make a payment, there is no reason why you have to wait for your payday, right? If we can facilitate that flexibility. So I think we are seeing more of that trend, right? We are seeing more workers trying to get that financial flexibility that they need to meet the needs that they have, right? That is a reality. That is the reason for earned wage access. We are facilitating so that people can pay their bills, so that people can, the holidays are coming. There's expenses, there's, gift shopping for your children. I mean, whatever need you have, buying groceries. I mean, these are things that can be met through on-demand pay. And, I think for employers, I mean, in a very competitive world where it's very hard to recruit and retain talent, right? This has become a powerful tool and a powerful incentive. There are research showing that employees will look at whether a company offers that flexibility of pay before they make a decision to join that company. So there are tremendous benefits to having that payroll flexibility that, we've shared, and also being, seeing more of that upward trend. So I think there is that, right? So I think, Gen Z definitely loves it, but I think across the board, I mean, there is no reason why we can't give people access to the money that, they legally should have access to.
Well said. Okay, so I want to shift gears a little bit to talk about the regulatory landscape. We are at an American FinTech Council webinar, so we really need to address that. So Ben, I'm gonna ask you to, if you could, kind of give us a little bit of an overview from where you stand on the regulatory landscape. Particularly, let's focus first on sort of the states that have been active in this on EWA.
Yeah, well, so I think, I think the first, to me, this sort of is like the birth of the regulatory system of earned wage access was the CFPB's payday rule in 2017. This was under Director Cordray as part of the payday rule. There was, this is 750-page long rule. There were, I think, 6 pages devoted to earned wage access and direct-to-consumer advance as the terms. That really, that was the first thing that differentiated and said, this is what EWA is. It's not a loan if it has these qualities. And where we are today is, that's like 1.0, we're at probably 4.0 or 5.0 now, but basically it said, if it's non-recourse and there's no mandatory payments or finance charges, it can be EWA instead of a loan. I mean, I think the industry has really built from there in a lot of ways. The state bills first started happening in 2019, 2020. A handful of states introduced bills. I think, my personal take on that is that the industry was probably still a little bit too young. There was, a desire from some policymakers to have bills, but just the industry was all over the place. It wasn't well understood by regulators or even companies on how to work together on an appropriate regulatory framework. So I would say those didn't really go anywhere. California signed an MOU with a number of companies in 2021. That was sort of, I think, another sort of landmark milestone like the payday rule, where basically say we would share data with the state of California, and they would use that to come up with a regulatory framework at some point in the future. 2023 was really, I think, the first year where serious legislation was introduced. I know I worked closely with a lot of the folks on this call, and others spent, hours and hours, weeks and months with regulators, with legislators, with attorneys general, trying to come up with what that appropriate framework is. I think on the legislative side, 13 states introduced some version of an EWA bill this year. It passed at least one house in, I think, 6 or 7 of those, signed into law in Missouri and Nevada. Nevada, as I mentioned earlier, Missouri was the first state to implement it, but Nevada was the first state to pass it. Most recently, Wisconsin passed a bill through their house just a few weeks ago. And so I think you'll see a lot more action happening in that sort of model, the Nevada model, coming up in future years. On the federal side, the CFPB put out an advisory opinion in 2020. They have stated sort of repeatedly that they're going to update that, although they haven't really said when. So we're looking at that. And then Representative Brian Stile from Wisconsin has a bill that he's been working on as well. That was noticed at a hearing about a month and a half ago. So that will be introduced at some point in the next couple of weeks or months as well.
That's a really helpful overview. Molly, I'm going to ask you, and Ben, you can jump in too, but can you talk a little bit about the content of the laws that were passed in Nevada and Missouri, sort of what some of the key features are and consumer protections and otherwise?
Absolutely. Yeah. So I think, at a high level, what the legislation in Nevada and subsequently Missouri did was create a new earned wage access license. So currently, many banking regulators have sort of a limited set of tools to provide oversight of this rapidly growing industry. And some have looked to put it into the credit bucket and see that it's not a fit for that. So realize they needed to make a new license, and that's done through the legislature usually. So for that new earned wage access license in Nevada, registration system in Missouri, and ones we're likely to see in other states, providers who register have to comply with a number of really important consumer protections. And the Nevada legislators were the first ones to really put those forward. They have new high standard requirements around verification of wages. So users can never access more money than they have actually earned. And that's a really important feature of earned wage access. It codifies that there's never any recourse against the user. So in no situation can anyone come after the user. It puts limits on fees and costs. So it bans late fees, penalties, things like that. And most notably, or one of the most notable things was it required a free option. So all EWA providers have to offer a free option to workers. Previously, many EWA providers did not have a free option. So that's been a significant change across the industry. It's sort of been alluded to earlier as well. There's a number of requirements around fee transparency and disclosures. Disclosure is a really important part of consumer protection. So users know what fees they're paying, what their options are, what the cost is. It prevents any sort of credit checks. Another thing in the Nevada bill is they have a sort of reporting requirement. So they have that continued insight into the industry, and providers have to report annually.
And are the regulators in question that oversee the licensing regime, are those the financial services regulators in each of those states?
Generally, yes. Yeah.
And how is it going in Nevada and Missouri since the bills have been passed? I mean, is it up and running? Is it still sort of in the early? It's obviously in the early stages, but have licenses been issued yet, or is that still?
Yeah. So as Ben mentioned earlier, Nevada passed it first, but Missouri was first out of the gate to get their registration system up and running. That deadline has passed for providers to register, and so I think Ben mentioned 21 providers have registered. That's pretty incredible, considering about 5 years ago there was only a handful of EWA providers. In Nevada, the licensing application is due end of year, so that's a bit more intensive of a process, and suspect those will all be out shortly in the beginning of the new year.
And those, am I correct that those bills also kind of clarified either explicitly or implicitly that that EWA is not a credit product, not a loan, but it's its own product?
Yeah, and I think just going to that, like there was a lot of ambiguity. There remains a lot of ambiguity around the product. So not only defining what it is and what it's not, but also like, the payday rule says it has to be non-recourse and you can't, sell the debt to a third-party collections agency. But like, can you do your own collections? What does that mean? Can you talk to some person? So we spent a lot of time with the legislators and regulators and again, like law enforcement and legal professionals, just like, what does that actually mean? And so how do we define those terms in a way that our compliance departments can ensure that we're compliant? The regulators can have confidence that they are judging on the appropriate criteria. And so I think even just if there were broad agreements of what is allowed and what's not allowed, once you would peel back 2 or 3 layers of the onion, there was really a lot of ambiguity there.
Mm-hmm. Well, sorry to interrupt. Part of that was a matter of education, right? And just because it's a new animal, people need to understand it, what it is and what it isn't. So your job, obviously you guys have been spending an enormous amount of time just educating folks, at least the staffers who don't already use it. And you had talked a little bit, Ben, about the federal bill. Is that the EWA Consumer Protection Act? Is that what you're referring to?
That sounds like it. I forget the title.
So do you want to just give, folks a little bit of a sense of what that bill contains, how much it mirrors, the Nevada and Missouri bills, and also if you have thoughts on sort of its prospects for passage, would be great.
Yeah. So I would say, like a lot of financial services, there are components of them that are regulated on the state level, and there are components that are regulated on the federal level. So what the federal bill that we've suggested include is a parallel to the state level. To my knowledge, there's no preemption. So basically, a few states have said we're going to regulate earned wage access like this along a bunch of principles. Right now, the federal law is ambiguous at best on how to regulate EWA. So what we're saying is, here's a set of principles. Federal law should reflect that. But there's no preemption, so states can implement what they want or not. And the federal law at the end of the day will implement when it wants not. It's hard to prognosticate. Very little is passing the federal level in general. So whereas states have the ability to act much quicker, I think anything on the federal level is going to take a while, but the stakes are also very high. So you need to make sure that you get it right. So I would say that the bill that was noticed in committee a couple of weeks ago has a lot of similar terminology, definitions, et cetera, to what was passed in Nevada and Missouri.
And I think
maybe I'll see if I can find it and put it in the chat.
Yeah, and I think just to add to your point, Ben, federally, right, we haven't seen this regulatory framework, right? So, what this bill does, it recognizes the nuances within the industry, even within the models, right? We applaud this bill because it recognizes the uniqueness of the employer-based model. As we continue to educate staffers, whether it's at the federal or at the state level, we have to remind folks that, these are not loans. These are products that are allowing employees to access the money that they've already worked for. Every characterization that says that this product is credit, it's really missing the benefits of the product to the consumer. And states of Missouri and Nevada recognize these nuances. They worked with multiple stakeholders to get this done. So it is definitely something doable, right? If we want to get it done. So I think we're hopeful, for DailyPay. One of the aspects that I take most pride in is that we actually partner with the Coordinated Assistance Network to provide free financial wellness for our users. So if you want to talk about protecting the consumer, we're not only allowing folks to access the money that they've earned, but we're also giving them tools so that they can budget, so that they can have greater control of their finances, right? So that is a part of financial inclusion. So I think as we're seeing not just Congress, but states having these conversations, more legislators are recognizing that you just can't put us in a bucket and say, you guys have to be analyzed through the lens of credit, because that would dramatically transform the product. And frankly, I am not too sure if that would actually have much benefits to consumer. I mean, we know that credit products come with fees. We're a non-recourse product that could potentially change if we were to become credit. I mean, there are these real life implications of a product. And most importantly, I think if these things were to move forward, it would really remove a lifeline for those employees who are trying to prevent from using, predatory payday loans or borrowing from family or friends, right? So it doesn't remove the need for liquidity. What it does is that it almost incentivizes some of these workers to seek these more costly alternatives so that they can make their ends meet.
Well, and as you suggest, it also characterizing it as a loan kind of threatens to remove the exactly the features that make it so beneficial for consumers, and ultimately, maybe opening Pandora's box. If you call it a loan, then you're sort of ushering in a world in which it may not be distinguishable from loans, fees and all the things that regulators are worried about with loans. So it's sort of a be careful what you wish for kind of regulatory situation. Let me, Rajat, let me ask you a question on that front. We've talked a little bit already about how this doesn't fit neatly into any existing regulatory bucket. And I'm interested in from where you sit at CLEO, how should regulators approach EWA or not approach it to benefit consumers most? What in your view, what's sort of the ideal way in which they should conceive of it, and how should they regulate it?
Yeah, absolutely. I think like calling it a loan probably feels convenient answer to the problem, but it's not the right answer. And it's going to be a tremendous disservice to consumers and the companies if it were categorized a loan, right? If we start to look deeply, right, the features that loans come with, there is an interest charge. The interest charge keeps on increasing the payment amount or outstanding due amount. if the consumer is not able to pay it on time, and if they are 30, 60 days dealing or late, then you get assessed late fees. You get assessed higher interest charges for delaying. These EWA products are highly transparent in nature. The fees is always disclosed upfront to the consumer before taking it. They have an option to, they always have a free option to use or not. And if they like the fee, they agree with the fee, they take the product. There is no charge later on for using the product. There is no late fee ever going to be slapped on the consumer. There is no like interest charges will never keep on increasing the payment. The other part is debt collection, right? That peace of mind that consumers have, that this is not going to be sold to a debt collection, right? How valuable that thing is. Like nobody appreciates a call from a debt collector. So those are very, very important salient points. That's why consumers, we are seeing such a huge demand from consumers because they love those benefits. And all of those benefits will disappear if this thing were treated as a loan. So we do need to recognize this as a new product in itself with all these benefits and kind of a new regulatory regime or paradigm for it.
Are you optimistic that regulators will see it the way you see it?
Yeah. I mean, I'm always an optimist, and we want to talk more and more about these products and features, and hopefully people do recognize the benefit.
I think everyone on this call is an optimist based on my conversations with them. And I do think it's just really notable, every time we meet with regulators or policymakers doing that sort of background or education work, there is so much appreciation for the product. There's a lot of sort of misconceptions coming into it. And once you get to sit down and have that conversation and really drill down into what the product is, I think a lot of people share that optimism.
So again, on the theme of optimism, and you're the one who likes Gen Z too. I want to ask you guys all about sort of what the future holds in terms of innovations and new aspects of EWA or new versions of EWA. So where do you see the product development going? What do employees and employers have to look forward to in terms of innovation here? And maybe I'll begin with Claudia if you have thoughts, but others should jump in too.
Yeah, I mean, I think like earned wage access is becoming a more mainstream tool, from the perspective of employers. I mean, this is making employers be more competitive when they're recruiting workers. And we're also seeing happier workers, which makes a big deal in terms of your productivity. So I think, the future of pay is here. The future of pay is here to stay. I think, I am, just like many folks on this call, we're engaged with regulators across the country, educating them on the nuances of the product so they understand, who we are and what we're not at the end of the day. And I think it takes time, right? I think we are in a very exciting time period where we are developing the foundations of what could be a regulatory framework for products like ours. But I think what we would like to see is, that uniformity, right? We want to make sure that we get it right, because that's going to impact what sort of products come into the marketplace. I mean, the world of innovation and competition, right? It doesn't stop. And those decisions that regulators are making right now are going to play, they're going to factor in and what sort of products are evolving, what we're developing. So I think we would like to see at this point, there is a trend in terms of pay, right? We see this to be a fast growing industry. I know Rajat's product, I've seen it. It's very cool. I know you guys use a lot of different technologies for it. Everyone can speak to the uniqueness of their products. And I think for us at DailyPay, you go pretty much everywhere and you see our logo, right? You are seeing employees happy because they're able to, take the money that they've already earned. They're able to make the payments on time. And that makes a big difference, right? There's, I think, a level here of almost financial dignity that you feel from being able to make ends meet, because, everyday Americans are working more, but not earning more, right? And I think that is a key concept and something that I explain to regulators all the time. Like, our product is not meant to solve for income insufficiency, right? Our product is meant to provide an alternative, a safe alternative, so that people who have worked and earned their money are able to access it when they need it. And that makes a key difference in someone's life. So, it's not just an abstract thinking, right? It's not just, I think sometimes in Washington, especially, we have these policy conversations, but it's like day to day, you know, someone right now is going on their app. I know that for some of our users, about a third of our users actually are using our app to check how much they've earned thus far, right? They can actually access their wages because it's like a real-time update. And, you know, and that, you know, it's gonna impact whether someone decides, hey, you know, I'm gonna pick up some additional shift this weekend because I've seen that I've earned, you know, $500, maybe more shifts, I can make $1,000, right? So that is going to factor in whether a worker, you know, wants to take another shift. So, you know, there are some real benefits there, I think, for the employer, but, you know, most importantly, I mean, it is supporting working families. You know, most Americans don't have the savings for an unexpected expense, and it doesn't have to be something insane. I think people, when they think about emergency expenses, they think that it has to be, you know, something life-changing, but it could be as simple as, you know, getting gas for your car, right? Like being able to pay the bills, to get the groceries, to buy, you know, to buy your diapers. Childcare in this country is so expensive. I mean, there's a plethora of policies that I think we could change at the federal level to make life for working Americans easier. But until we do that, you know, our products are providing a real financial benefit that is meaningful for so many families across the country.
Yeah, really well said. So Rajat, I want to ask you kind of on the technology side. I think Claudia kind of threw you into that realm. Can you talk a little bit about sort of what you see on the technology front and innovation front in terms of how this product may evolve over time? I know we've talked a little bit about financial literacy, some of the other aspects that sort of surround the core product. If you have thoughts on that, I think viewers would be interested.
So so CLEO is an AI-based financial assistant, right? EWA is one product in the toolkit. Our goal is to help people with their financial lives and help them build a life beyond paycheck to paycheck. And to build a safety net, you need to provide coaching and education, but coaching and education can only go so far without the right tools. So we have budgeting and savings tools. We actually ran campaigns around Black Friday, educating people that how 42% of the users regret their spending on Black Friday. And all of that education is good and helpful to save their money. But then what do they do? So we build a savings product where we allow them to start saving and, you know, get high interest rates. The other piece is also saving them from expensive bank fees. Overdraft, right? Still in this world we live today, and overdraft still exist. And like some of the largest banks in the country charge $30 to $33 for per overdraft, and maybe consumers have to pay 3 overdrafts per day sometimes. So if you're paying hundreds of dollars in bank fees, that's stressful, right? And people are living on the edge. And sometimes if they miss their bill payments, the late fees are also of the order of magnitude, somewhere between $20, $30 of late fees per bill. So there's a lot of stress that people are living with, and they need tools. And if we leave them at the mercy of like other payday lenders or reaching out to other high expensive forms of credit, then they can never get out of that hamster wheel. So this is one product that fits into that arsenal, that if you have an issue, if you have emergency or anything, you can tap into EWA products to save from those bank fees. And this is just meant to, right? You're not meant to rely on this perpetually, but just to bridge that gap when you have an emergency. But then after that, you're supposed to actually build a safety net for yourself. So next time you have an emergency, you're not relying on other extra forms of credit, but you actually build a safety net for yourself. So that's how CLEO is thinking about it holistically to help improve the financial health of users. And we have technology, right? AI, we are a chatbot. Thanks to the great developments on the AI front and large language models, they enable us to provide custom financial advice to every single consumer, customized to their spending patterns, their behavior, their lifestyle. So you can actually bring custom advice to those consumers.
That seems to me to be the key that we're just at the beginning of, right? And that the notion that, you know, the information data that you gather in a secure, you know, private way, but over time can give you the ability to help consumers really manage their finances unique in the way that is unique to them and that understands their situation and gives them key nudges and reminders and education, financial education, both sort of writ large and very on a daily real-time basis. That's a pretty powerful tool. And I can imagine EWA, in 10 years when we're having this webinar, it may not be sort of EWA, it may just be EWA may be part of a whole suite of kind of, products that all point in the same direction, all help people kind of manage their lives, more effectively, and avoid the kind of traps and fees that burden so many people. Do I see, Molly? I see you nodding. If you have, do you have other thoughts in this in terms of the future of EWA or sort of what we're seeing in terms of innovation?
Yeah, happy to just chime in briefly. And I think some of the AI innovations are pretty incredible, and I look forward to seeing where those go. I think, one of the things we've spent a lot of time on this call talking about is earned wage access, because that's sort of the entry point to a lot of our apps for the providers on this call. At PayActiv, certainly view ourselves as a holistic financial wellness offering. And I think when you look to the future of what those innovations will be in this space, I think one of the under-discussed pieces is on like the unbanked and underbanked, and how earned wage access is a really important entry point of getting them these financial services, of helping them, get their first debit card, working on like credit building features and other things that sort of help improve their financial lives overall, specifically for that sector of people that need that specific attention.
Yeah,
So-
and sorry, go ahead, Ben.
I was just saying, I'll close with this on this topic. So I used to work for Amazon, and like Jeff Bezos would ask this question, like lots of stuff is going to change, but what isn't going to change? And at Amazon, it was like people are always going to want lower prices, people are always going to want more selection, and people are always going to want faster delivery. So one of the first questions when I started EarnIN was I asked our CEO, like, what do you think is, what's not going to change for earned wage access? And people are always going to want their money faster. So like, income is like the highest funding source for like, millions, hundreds of millions of American families. But it's delayed for days or weeks until they get that money. So I think the future of the product inevitably is going to be about velocity. And we've seen it in so many other sectors of both financial services and the economy more broadly. Like the inevitable state is people are going to get paid in real time or very near real time. Now, how do we get from there, to there from here? Like hundreds of thousands of people, millions of people still get paid by paper checks or by, in cash. So it's probably going to be a while, but that's where I see the end state going.
Where essentially every employee will expect to be able to be paid virtually instantly after the hour is worked or after the minute is worked, and that expectation will be built into sort of our workplace in a way that's seamless, and we won't be talking about a particular product. We'll be talking about, just an ecosystem. I mean, one of the things we've already talked about the fees, the kinds of fees and charges that EWA allows consumers to avoid. The other side of that same coin, I think, is the opportunities that people with savings and with wealth have to take advantage of opportunities that arise, not just paying required costs, but also opportunities, whether something simple as taking your family out to dinner when there's a reason to, or having an economic opportunity, to invest in something. To those kinds of opportunities only come when you have the financial flexibility, you have the ability, you have the resources, and EWA also, helps on that front as well, on both sides of that equation. And I don't think people fully appreciate the value of that flexibility for workers, and not just, low-income workers across the spectrum. So we've covered most of our topics, basically, and we've reached close to the end. I don't see there was the possibility of questions and answers. We have a Q&A thing, and if anyone wants to throw a question in the Q&A, they can right now. We'll see if we can answer it. But we'll give folks a little bit to do that. Oh, I see one question, but in the meantime, I want to ask before we get to this question, do any of the panelists have any other thoughts they wanted to add that we haven't covered already? Okay, well, I'm going to jump in then. I think you can all see this question. Can you speak to the proposed California regulations and their 5% cap, which it seems to me could have the unintended consequence of making a certain segment of customers pay more than they pay now if they are currently opting to tip less than 5% and not to expedite payment? Ben, do you have any thoughts on that? I'll put you.
Well, yeah, sure. I'm happy to take it. And Brent, thanks for the question. I think, you know, the question of fee caps is something that we get asked about a lot. And, you know, in at least half a dozen states, regulators are asking about it. And I think it's a really good question, and we've had a lot of really good debates about it. So for those of you that aren't familiar, in part of their proposed rule, California basically said, instead of the freemium model that we now have, where there has to be a free service, but you can opt into paid options, you can have a 5% fee cap, but that's it, as an origination fee, and then you can have a $10 or a $15 late fee and some interest depending on how long the transaction is outstanding. And we were able to sort of do the math, and it's a very similar dollar amount that we would make, but make the comparison on a consumer basis that, as the question says, like many people would pay more for the service than they are now. And the fact that there is a late fee and interest that the product doesn't currently have are things that, you know, you can have that debate of whether that fee structure is better for consumers. I would make the argument that it's not, and that being completely upfront and transparent about the fees, which the product that's currently offered is much more consumer friendly than, you know, the mandatory fee cost plus the option for late fee and interest. So usually I would say when we've sort of laid out those options, I can't think of a legislator who has said, yes, the 5% origination fee and late fees are better than ours. So generally, the free option that is inherent in the, Nevada and Missouri bills has generally been the one that has been a consensus for most legislators we've talked to.
I'd also add specifically on California. California first proposed their draft regulations. So shortly after signing the MOUs, proposed their first draft regulations on earned wage access about 2 years ago now. We're sort of in the third or fourth draft. They're not final. The latest version removed the fee cap. So we don't know yet where the DFPI will land on that, but that's still in draft form.
Do you have one more question here if anyone wants to take, and then we're going to wrap up. How do the providers view wage assignment legislation as a risk to their business models or otherwise? Anyone want to take that?
I would say I don't know. Generally, the wage assignment laws in most states, as we understand them, have like a legal obligation to pay. So they're going to be regulated a little bit different than EWA is. But I think that would be the devil's in the details on those kind of things. So we'd have to take anyone on its specific merits.
Great. Well, I want to thank you all members of the panel, and I want to thank the American FinTech Council for organizing this. It's obviously a critical topic, and we're delighted to shed a little light on it today. So thank you all for joining us, and thank you participants and audience members for listening in and watching the panel. So thank you all, and have a great day.